Hello, everybody. Welcome to Friday, another Talk Money with Tom show. This show is about trying to help you have a better retirement, especially in the area of finance. We really do that through three different ways. Now, first of all, we answer your questions live here on the show. You can send them in to the email address at asktom@talkmoneywithtom.com. You can send them to the chat box. You can send them during the week, what have you. We also post lots of educational content on this channel. We feel like that's important to help you get farther along with your retirement goals, whether you're retired already or going to be. And you can subscribe to the channel, hit the bell button if you want to get notified when we put new content on. And of course, the third way we can help you really, if you want, is to meet with Easton and I. 30 minutes. You go to our website. There's a book appointment button up in the corner. Pick a 30-minute time to meet with Easton and I, and we'll cover you on a phone or a video conference. And try to help you out on a personal basis. So looking forward to today's show. Hope that we can help you. We really enjoy this. Start sending in your questions. We'd love to be able to try to answer them live here on the show. And of course, you can send them for next week too, and we'll be ready for that as far as that goes. All right, I do like to start off each show with a summary of kind of what we saw happening with the market. And of course, this chart, should be familiar with this, it's the S&P 500, right, coming down in this case with that red line across the top. The blue line is the 200-day moving average. So there's some very significant things that have happened here over the last couple of weeks. First of all, we broke through the 200-day moving average, which is a big piece of a checklist for seeing a reversal of this downturn. Number two is we broke through that trend line for the first time since this thing started. Okay, and we're still above it, and we're kind of well above it. And then this week, we actually hit a new high that's higher than the previous high. So if you look at all the highs all the way down, they're all lower, right? Kind of underneath that red line. And we've never had one that's exceeded the previous high. So this is the first one. It was around 4,100 on the S&P 500. We broke that 3 days ago. We've held it yesterday, held it today so far as that goes. So good motion, lots of good things happening. And then yesterday we had one other significant thing happen. And that's what's called the golden cross. And so the 200-day moving average is the blue line. The yellow line is the 50-day moving average. And when the yellow line comes back up through the blue line, that's a good sign. A lot of people watch this. And so that's somewhat important as far as that goes. So it's got a fairly good track record.
Yeah.
Right?
But sometimes it has failed. And so I think they say around 72% of the time you'll end up higher in 6 months. So
and in my view of it and looking back, when I see the bigger downturns, it has had a pretty good track record. When you look at 2020, when you look at 2018's downturn, when you look at 2008 downturn, all of those has signaled a point to get back into the market where it would have gone higher. However, it comes in late, right, because it's very slow moving. There's two big averages. And if you look here, if this is a reversal, and I'm not saying it is, it's got a lot of check marks here. I like it. But if this is a reversal, the bottom was in the middle of October. So it's pretty late, right? But it's another confirmation. And it's really one of the main reasons why we use the dip that's happening today in the market to kind of go back in with the rest of our portfolio money. We've had money in our bond portion and our stock portion moved out to ultra short-term bonds and T-bills, and we move that back in. And so we're back into fully invested in our model. So if somebody is 60% stock and 40% bond or what have you, they're back into those pieces. We'll see how long this lasts. I mean, one of the things that's very interesting about this is just the fact that this is such a unique environment. And I've been talking about this, that could be good, so everybody expects certain bad things to happen, but the pandemic and the pent-up demand could offset those. It also could be worse because of the pandemic that's created these situations. So it's a little difficult to look at past history and say, okay, these are all the things that have to happen. We just have to keep watching and seeing what's going on. But the overall price action is quite good. It's pretty decent here.
Yeah, and it's interesting because the different indexes have been peaking or hitting this golden cross at different times. The Dow hit it in December, so it's much earlier.
Yep, exactly. And that's another sign that you look for. You look for confirmation from other indexes. to see that this overall broad motion is happening as far as that goes. And so this is a chart for this week. Each one of these little bars is 5 minutes. You can see the big jump here in the middle of the week. And that has to do with the Fed Reserve coming out, Chairman Powell doing the question and answer. And I watched the question and answer like I've watched the others. And really, it was kind of remarkable to me. He had some chances to be more aggressive, and he didn't. He talked about more things that I think were positive than I've seen in the past. I was expecting a very aggressive, hawkish question and answer period because they're trying to drive down the stock market to tighten up monetary situation. But I think they're seeing behind the scenes that things are doing pretty well. It's the first time he used the word disinflation, really, since this all started, which just means lower inflation.
Yeah, it's a bit of a weird word.
It is. It's not inflation. It's not deflation. It's in between. It's disinflation. But nonetheless, those types of things that he says are important. The market jumped onto those and moved upward. Now we're seeing a downward movement now, right, in Friday. And that has to do with the report that came out this morning on the jobs report. And it's really kind of an interesting mixed bag. And I'll show you kind of what happened here. And personally, I think that in order to understand this market, the way it's going right now, and what's going to happen with inflation, what might happen with recession, you need to understand the labor market. Okay, and I'll tell you why. But so this is the report that came out today. I've got a year's worth of data here, but we had 517,000 jobs created in January. Okay, that's pretty good.
Yeah.
Especially since the expectation for new job growth was 188,000. So that's the biggest jump since the pandemic that I can think of, percentage-wise. I mean, that's what working on 2.5 times higher than expected. So that's huge. And so you'd think, oh, the market would love that. Well, of course, the market dropped, and down 1.2% or something as we do the show right now. We're still live here, market's still open, but and the reason is because of the fear of a tight labor market, where the Federal Reserve might raise rates even further. And we did see the 2-year Treasury rate go up today, not anywhere near where it was at a high, but up nonetheless. And we saw that the futures markets guesstimate on where the Fed funds will terminate, where it will hit the highest point, went up to 5% today.
Yeah, and the odds for everyone's kind of expecting that in March we're going to have another quarter point. But in May, a lot of the expectation before today was we're going to hold steady.
Right.
And so it was about 60% there would be no change to the rate. But now that got flipped to 60% that there will be an increase, a quarter point.
Right, exactly. And that's coming from this report, essentially. Because what happens, the Federal Reserve has a dual mandate. Create, full employment, and they have an interesting definition for that, but nonetheless, and keep inflation low. 2% on core PCE is the main piece. And so when the job market gets hot, it just means, hey, the Fed can just spend more time and energy and put more effort towards raising rates to kind of slow things down. So we'll see how that plays out. Again, the Fed funds futures rate is still kind of at 5%, which is a little bit lower than what the expectation is right now. So we'll see how that plays out. This is one of the other pieces that kind of bothers the market a little bit. And again, these things are kind of ironic, but because low unemployment seems like a good thing.
Yeah.
Well, 3.4% was reported today, which is actually lower than it was prior to the pandemic. You can see the job losses, essentially, unemployment skyrocketed during the pandemic because everybody was laid off. But it was at 3.5% before that started. So, good, tight labor market. And the other thing that worries the Fed is just the number of job openings is still really high. This is going back to 2012. And so you see there's like less than 4 million job openings back at that time. And now we have 11 million. And it is off of its high, right?
Yep.
So that's good. But all of those things are what is bothering the market right now, is just this fact that, when you have a tight labor market and you have all kinds of new jobs created and lots of jobs that are still being, open and what have you, you end up with a scenario where wages could grow, and that means that more inflationary pressure, and the Fed's got to come in and hit it harder with interest rates, which would then translate to, more impact on earnings and eventually hit the stock market, right?
Yeah.
Yeah. So, but here's my outlook on it. A little bit of a twist on this because I actually see some really good things in this report. I would not be surprised to see next week be an okay week, unless there's just some awful earnings or something that comes along. Because once people kind of dig into this, so first of all, the labor force participation rate is continuing to go up, and it tied the highest point since the pandemic, 62.4%. So this is the number of people over age 16 that are looking for work or currently working. So 62% of all the people that fit in that category are working. Now, it was higher, 63.5, right? I know that doesn't seem like much, but every 1% is about 1.6 million people.
Quite a few people.
Yeah, we still got a ways to go. Now, it's going to be fascinating to see how this goes, but here's the key thing. Inflation is kind of bifurcated into two places. It's goods, things that we can buy, and TVs. Everybody's buying big screen TVs for the Super Bowl. They're on sale. So we're actually seeing deflation, lower prices in goods. So we're seeing markdowns in Teslas. We're seeing, all of these different things that are happening. But services is where everybody's shifted their money. Chairman Powell talked about that a lot, actually, that services are still quite hot. And it's obvious. There's pent-up demand. We can go out to restaurants. We can go travel. We can go, fly in airplanes and those types of things. And there's still a lot of people that aren't doing that on a regular basis. And that's still coming, right? So that's still growing and growing and growing. That takes labor.
Yeah.
Right? And so we need more people. We need these people back in that were here before because we actually have more job openings than before the pandemic. I mean, if we go back, that's what's kind of fascinating. Look, the pandemic had, 7 million job opens prior. We're at 11 million. And again, this is this pent-up demand. This is the money that was pumped out into the economy. And so, sorry, wrong way. And so I think this portion here where the wage rate has come down is another big bonus, right? So participation rate coming up, we desperately need to see that. I think that's super important. Because the more people that participate, the better. And we were able to create 517,000 jobs, and the average year-over-year growth in wages is still coming down.
Yeah, that's a good sign.
Unless you have a job that requires, and you would love to see that go up. But in an inflationary environment, yes, it's a good sign.
Yeah, and with this job report, they also reported that people are working longer hours. So they said on average, for a 40-hour work week, people are working 18 minutes more. And that seems like a small number, but that when the report says if you average it out from the workforce, that's 160 million more hours of work.
Wow, that's a lot of work. Yeah, and so I think it's really fascinating what's happening here. I personally feel like this report is more positive than the market is acknowledging at this point in time, because one of the key aspects besides inflation is recession. And so if you have more jobs, if you have, this more participation, that can help you soften that recessionary blow that might be coming. So I think, and personally, I think that's probably the bigger threat to the market right now is recession and how that's going to impact earnings. So let's talk about earnings real quick. This is a pretty cool chart. This goes way back to the 80s. And what it does is the green lines show how many companies in the S&P 500 on a percentage basis are reporting positive surprises. So the expectation was here and they ended up higher, right? And the purple lines underneath are how many had negative surprises. And so we're at half of the S&P 500 as reported so far. 70% of those have beaten expectations. That's better than I thought would happen, and it certainly seems to be better than what the market thought would happen, and is partly why we're seeing this run up in the market overall since earnings season started. And we've seen like Apple last night report and miss on revenues, miss on earnings, and drop after hours. But then once everybody kind of digested the data and really looked at what was happening and realized that a lot of their problems were production issues that were caused by zero COVID in China, which is temporary. Just before the show started here, Apple was at 2.9% on the upside. So, I think that the earnings piece is still playing out here. We'll see how this goes. But I do think this is a big piece that is continuing to support the market. You can definitely see there's a trend downward from what we had in the 20s. The 5-year trend of surprises is at 77%, according to FactSet. We're at 70. So it's not bad. We're doing okay. We're doing better, I think, overall than what the big money was expecting, at least from what I was seeing as far as that goes. So very fascinating time frame to kind of see how this plays out, but a good time to kind of really be paying attention. There's a lot to learn here in this type of market. All right, so what's our first question?
Are stocks climbing too fast?
Our stock's climbing too fast. Yeah, I mean, we are definitely seeing, a very nice motion here in the last couple weeks.
Yeah, the Nasdaq flew up in January.
Yeah, no kidding. I think it was up over 10% in January altogether, which is one of the better starts to a year for the Nasdaq, actually, which is saying something, because the Nasdaq has had some pretty amazing times. But I think there's some definite possibilities of that. I even talked about that in my video yesterday, my daily video, that we have to have a little bit of caution here, that things are getting a little bit, high. We still went in today. Maybe there's some pullback, but there's enough pieces and enough check marks there to say, okay, this is a chance to get back in there. We'll get defensive if we have to, but I do have some slides to share that I think will kind of show us how this works. So this is what's called the Relative Strength Index. People call it RSI. This is on the S&P 500. And you can see when it gets above 70%, it's considered, kind of overpriced and stretched. And you can see we got close to that yesterday. We're actually back down off of it a bit today. But if you look back, that peak that went over 70% was back in August, and really that big run from the summer of last year. And you can see that climbing up. Now, there's a couple things to keep in mind here. First of all, we do have some room. We could run for a couple weeks and maybe get to that level that we had back in August in theory. So there's still some upside room here. But if this is a reversal of trend and the market is reversing back to a positive upward primary trend, you will see bigger stretches than normal. I mean, you could get up to 80 and 90% in those type of markets, and that's what we've seen in the past. And because there's this pent-up, money that's sitting there on the sidelines, there's all of this overhead short positions. People start getting out of those shorts in a panic, and when they do that, they're buying back the stock to get out. And then the institutions eventually start to get involved, and that's what we really haven't seen. If you look closely at the upturn that happened in August and July of last year, it was the same stuff that was driving the 2020 market for the most part. If you look at what's driving the market now, it's the same stuff that was driving in 2020. To me, that's the individual investor predominantly, still in there, still buying. They're using their call options to kind of make outsized move for smaller dollar amounts. But we haven't seen, in my opinion, a full movement back in from the institutions, the pensions, the hedge funds. And that's what's really going to happen to kind of see that thing run. If we ever do see that, and maybe this isn't it, maybe this is just another, peak and we'll come back down again. But if we ever do see that, you will see a bigger stretch. You will see the market move past this. And there's another indicator here also, which is just the percentage of stocks above the 50-day moving average on the New York Stock Exchange. And so again, we're at, 81% as of yesterday. That probably comes down today, right? This is reported after hours, so it's not up to date for today. But and that's roughly where we were back in that peak in August. So definitely up there in terms of pricing. As far as that goes, I'm glad that we were 75% invested with our equity during this run. But overall, just keep in mind that those can go a lot higher if this is a primary directional change. And we'll find out here shortly over the next few weeks how that's going to play out. However, on a short-term basis, I'm not surprised to see something like today where the market's down a bit.
Yeah, you can see there's some crazy, I would say more of the meme stocks have been running in this January.
Yeah.
Like Carvana for the year to date, it's up 200%. AMC is up 50%.
Yeah.
And so you have some crazy numbers out there.
Nvidia is sort of, I don't know that it's technically a meme stock, but it sort of seems like one. I mean, it's up over 40%. It's a fairly big company just for the year also. So yeah, there's some crazy numbers going on out there where, people are jumping in and riding this. So, we'll see how that plays. But, I mean, to answer the question, yes, there is a little bit of stretch here as far as that goes, that's for sure. All right, what's our next question?
What would a soft landing look like? The Fed has mentioned it multiple times, kind of this Goldilocks situation.
Yeah, actually, Jay Powell said that he knows it's not the consensus, estimate that we will end up with a soft landing, but he sees it as a possibility. Read what you want into that, but what is it? So, because honestly, if you watch some of these conferences, the people that are asking the questions know a lot about the market. So, first, I would start with what it's not. It's not a recession, right? And maybe that's one of the easier ways to kind of understand it. So recession usually means high unemployment, economic pain, right? Maybe more defaults on loans and different things along those lines. A situation like this with a soft landing, you would just have slower growth.
Yeah.
Pretty much what we had last year, maybe keeping going for a while. So, for example, last year the GDP growth was 1%.
Yeah.
Right? That's slow growth. And the Federal Reserve Chairman Powell talked many times in all of his speeches about subpar growth is what they're expecting. It's what they're trying to accomplish because they need to get some of this demand to come back down. And so it worked on goods, right? They brought demand down. And now we're starting to see goods, literally deflation in the goods area. But the problem is really in services. And so they're trying to have people spend less money by, making things tighter. And really, to me, it's a blunt tool they're trying to fix. It's all they can do. But that's why this jobs report today, I think, is so important. It does lean itself more towards a soft landing. Because if you get more people back into the workforce and you do so with, less growth in pay and the participation rate comes up, you end up with a situation where you might be able to, have that inflation come back down because job growth helps both sides. Keeps you away from a recession, at least temporarily, but it also fills a need. We need to get people back to work to get inflation down in services.
Yep.
Right? I mean, it's a simple example. If there's a line outside the door of a restaurant because they don't have enough bus people and cooks and waiters and what have you, that means that restaurant could charge more per seat, right? And because the demand is there and people are desperate to go out to eat. If, on the other hand, you have enough people working there and the demand is still the same but the line is shorter or non-existent, restaurant doesn't have the same power to move that price up, right? So if you need the people and you need to get the people. So that's why I think today's report with 517,000 jobs created in January versus 188,000 expected could be a leading indicator of what might be helping in the analysis of a soft landing. So it's a narrow landing strip.
Yeah.
So, and it's, 1994 is one that they talk about. So that just tells you it doesn't happen very often because you can name them. They're not that many. So, however, there are a lot of different variations of recession too. Obviously the 2008 recession was really, really bad versus 2000, which was pretty bad also, but not quite as bad as 2008, for example. So you can end up with different levels. And the markets already had dropped 28% from high to low. How much have they already factored in lower earnings, lower, a possible recession, anyway? Because in the end, it's not so much for me about soft landing as it is about what's the stock market going to do.
Yeah.
And it would do better in a soft landing situation. But it's a good question. It's something to really try to understand. And it will be the battle that is going to happen this year. Most people expect a recession to start in the second half of the year. If you believe in a soft landing, then maybe you don't expect that, right? So
yeah, and there's been talks with I think the Goldman Sachs economist essentially said that Fed will keep interest rates all the way to 2024 without decreasing them. So
right.
They're maybe seeing less of a recession chance.
Yeah, because that would be the thing that makes the interest rates come back down, right? I mean, why would the Federal Reserve lower rates? They'd lower rates because the economy's falling apart or unemployment's getting untenable, and so they want to support that by lowering rates back. The futures market is expecting some rate decreases later on in this year. That's a sign that the future market feels like there'll be some type of recession in the later portion of this year. But the Federal Reserve has said that they're not planning on lowering rates at all in 2023. Multiple sources have said that, including Jay Powell during the conference, the Q&A this week. So, again, if you look at that, that means they're not expecting a recession to be happening either. So their track record on what they expect and what's happened has been a little bit suspect, so we'll see how that plays out. But nonetheless, that is the battle that we're going to be talking about. It's probably one of the most important subjects. What's this recession, if we have one, going to be like? And the market's going to have to react to that. In the end, the rubber does hit the road. It is about earnings. First quarter earnings are supposed to be worse than they have been so far, so that's good. So it's quarter by quarter. What's going to happen next quarter, third quarter, et cetera? How does this play out? Good. All right, so what do we have for next question?
How do you stay current with the changes in the financial industry and market conditions?
How do you stay current? Okay, so that's a good question. First of all, it depends on your level of desire to stay current. So, I subscribe to everything I can get my hands on. Seeking Alpha, Market Watch, Barron's, Wall Street Journal, Bloomberg, which actually is one of my favorites. I've had to choose out of that. Bloomberg would definitely be one. We have, all Yahoo Finance, which is free. That's actually pretty good. Has some good pieces on it. Some good write-ups on what's happening, some good analysis. And so those are start places. I use an app on my phone called Flipboard, and Flipboard's really awesome. You can flip through. I must flip through hundreds of articles, a day, and so you can classify those as finance articles or stock market articles, and you just go to that classification. You just start flipping through, and it's really, really good resource. Actually, you'll get some of the write-ups from some of the same places I just mentioned. It often has a firewall for some of those pieces. You can't read the whole thing, but it does give you at least a flavor for what's happening just via the headlines, to be honest. So I think those are some of the ways that I try to keep up with the market. Of course, lots of looking at charts.
Yeah.
To me, the data is, all of the information is pretty much in the price. And so that's one of the reasons why we went back in the market. You can say what you want about possible recession or too much inflation or the labor market's too tight or whatever. This stock market hit a bottom in October, middle of October. It continues to show strength. It's broken through barrier after barrier. The stock market's trying to tell us something. Doesn't always work, but you've got to pay attention to the price and what's happening. So for me, if I had to watch one thing, it'd be the S&P 500. That's why we talk about it all the time, but there's lots of different things to look at on the different charts also.
Yeah, if you're not looking to know everything about the market, there's a lot of free newsletters that you can get that kind of summarize what's happened in a day. And so if you read those, you can get a quick blurb of what's happening. A lot of these newsletters are pretty good. They're going to have some advertising. Usually that's how they're free.
Well, I have a great suggestion.
Oh.
So I put out a video every single day on what's happening with the market. And the Monday through Thursday videos are 2-3 minutes?
Yep.
Almost all of them. So 2-3 minutes, you click on that, and I'll give you what I see as the highlights for the market, what's happening, as far as that goes. I try to boil down all the things that have happened that you might have to spend a half an hour watching, and you can watch it in a couple minutes. And we've been doing that. We started that at the very bottom of the pandemic, the 23rd of March. We've been doing that pretty much every single day outside of vacations and what have you. We do the summary here on the show. We also publish that separately on the website for those people that don't want to watch the whole show. So this channel is not a bad place to keep up with what's happening with the market. Watch that summary. I think we're usually in the kind of 12 to 20 minute range on the summary per week, and then the 2 to 3 minute daily ones Monday through Thursday. So, that's why people watch them.
Mm-hmm.
Yeah.
Yeah.
All right, it's a good question.
What is direct indexing, and how is it different than index funds?
Yeah, direct indexing is still really in its infancy. I ran into it, I guess, a couple of years ago. And so an index fund is like Vanguard Total Stock Market Index, right? And the ETF version of that, the ticker symbol is VTI. And they just buy the stocks that are on that index. It could be the S&P 500. Vanguard's S&P 500 is VOO for the ETF version, right? For example, they're buying the 500 stocks on that index. Great. But what if you want to create your own index? And there's lots of different ways. You could say, okay, I'm going to pick 50 stocks out of the 500 in the S&P 500. That's going to be my index. Or I'm going to put together a couple of different ETFs and create an index of those, right? And where you can just buy that one index and it has those other pieces in them. And so we're starting to see more and more of the big institutions offer this as a service where you can kind of create your own index. Probably more important for somebody like me than it is for an individual trying to do their own investing. So in other words, if I really wanted to take 8 different ETFs and put them into one index so I could easily buy that, that helps me. It's just more efficient in terms of dealing with 800 and some odd accounts that we have. It's a little bit easier than having all 8 of those have to transact in those 800 accounts. And so, but as an individual, if I had to have 8 ETFs in my account, that's not that big of a deal, right? Because there is going to be some cost, most likely overhead cost, internal cost for creating that direct index.
Yeah, and there's some efficiencies for doing direct indexing. Say you want tax harvested a lot at the end of the year. When you do that, you can pick individual positions and harvest out. And it's a little bit harder when you're saying, I bought the VTI, for example.
Yeah.
I can't just pick 1 or 2 positions inside of VTI and harvest those losses.
Yeah, that's a cool concept, right? I mean, because VTI is 4,200, 4,300 stocks, but even if you take the S&P 500, hey, maybe there's, S&P's up for that year. Let's say it's up 10%, but there's 50 stocks in there that are down 10%. So theoretically, if you were doing tax loss harvesting, you could sell those 50, at least for 31 days, and take off some of the gains that you had in that, overall piece. And that's where direct indexing really allows that kind of direct harvesting. That's a good point, right? Because you can't do it otherwise. I mean, you buy the S&P 500, you're going to get whatever you get, and you're going to get the winners and losers.
Yeah.
Right? So,
but there's also the other side of the coin is that if you trade within a year of that, you're going to get hit with short-term capital gains, which is your general income tax rate.
That's
and
right.
So there's still some issues with taxes if you're in a taxable account with this kind of process.
Yeah, exactly. Yeah, and taxes are a big deal. We bifurcate our accounts into taxable and non-taxable, right? Non-taxable would be tax deferred or tax-free, like our 401k IRA or a Roth, IRA, those type of things. And we're pretty free to do what we want to do in those, just in the sense that we don't have to worry about tax. In the taxable accounts, it's much more onerous. You really got to think about what you're doing. When do you take gains and such too. So, but this direct indexing would allow you to kind of manage that and capture losses, which, generally speaking, is always a good idea.
Yeah.
In my opinion, when you should take gains. So, short-term gain is more taxable. I'm going to wait for a year. Well, what if by the end of that year you don't have any more gains? So you have to be a little careful there. There's a kind of an art to that, figuring that out. But nonetheless, you want to be able to capture all the losses that you can all the time, because you can carry them forward year after year. And capture. And we captured a lot of losses last year. It's the only good thing you get out of a market like that, in my opinion.
Yeah, and so direct indexing is really about getting that more custom solution for yourself.
Yeah.
Versus just an index fund.
Yeah. Okay.
I'm thinking about buying a new car. Should I wait or buy now? We've seen a lot of slashing of prices with like Tesla slashing their prices and Ford falling along. Is it a good time to buy?
So in 2021, in many conversations with clients in early 2022, thinking about buying a car, whether it was used car or new car, there's nothing available. I remember having a conversation with a friend of mine who's a fleet dealer down in LA, and they usually have 600-700 cars on hand, and they had like 7. I think that was September of 2021 actually. So that is now dissipated, right? They're finally starting. If you remember back then, it was the chips. It didn't have chips. Ford made all these trucks without some of the chips in them, just sitting, out in the parking lots and what have you. There's some really wild pictures. And so I did say at that time, look, the normal process for what happens in these environments is that when we have shortage, we end up with surplus, especially when it comes to goods, and especially something that's difficult to make and takes time to make, like a car, right? So we've got this demand. We can't keep up with demand, so we do all these things to get our demand up. And then if the demand diminishes at all, now all of a sudden we have this big surplus. And I was talking about how we're going to see discounts and cars on sale. I think personally the Tesla thing's a kind of a unique story. That deterioration in demand had a lot to do with what was going on with Elon Musk at the time. And Ford matched that probably just to match, the overall market share that they're trying to get into that EV space. I don't think that's what I'm talking about yet. But if you look at the Wall Street Journal article that came out last month, they're talking about maybe this fall, where you'd finally have kind of that supply just outstripping demand in total, not just Tesla or whoever, but all the way across the board. And so you might see some dealerships that are willing to deal and give offers, and maybe some better, because one of the average loan has gone up dramatically. I think it's 6.2% now is the average car loan. And so, maybe somebody's offering 3.9 as part of an inducement. So these are all things that they do to try to get the things to move, right? And we're not seeing much of that yet. And so I think what this was spelled out in this Wall Street Journal article seemed to make sense to me. This second half of this year might be a good time to be looking for a car.
Yeah, especially if we do fall into a recession. Usually when there's a recession, more expensive goods, that's when you can get them at a discount.
Yeah, exactly. And so it's always a bit of a challenge to try to figure out, the timing of those things. And it's certainly better now, I think, than it probably was back then, just in terms of, being able to get a car. My friend who I mentioned, the fleet dealer, he said basically we were just taking orders, and they would go make the car, and you were 3-4 months off from getting your car. So that's gotten better, but I don't think we have the glut yet that gets the real discounts. But that's probably coming.
Yeah, I can see that there's going to be a glut in the used market for sure. Because a lot of people bought when used car prices were way above, and now they're underwater on their loans, and so they may be defaulting on those.
Yeah, exactly. Yeah, the junk car loans, essentially. Because we had junk mortgages for a while, which was a really dangerous thing to have as a world economy. And so, but the money's still there. The banks still got to lend it out to somebody, and so they get kind of desperate sometimes, to lend it out. And so I think there are probably a bunch of cars that are going to be repossessed here as things slow down, especially if there is some recession that happens that usually is accomplished by higher unemployment. So if you got a big car payment, that could be an issue too. So yeah, that will bring things onto the market. But people are buying more and not leasing. So that's kind of a negative for the used car market, just because that doesn't come back onto the used car arena. But yeah, this is all pandemic related. Everything that we're kind of deal with. I know we're not thinking about the pandemic as much anymore. We're traveling and going out to eat, potentially. But it's still reverberating through the economy and through the stock market and through all of these areas. So we're a ways away from really getting clear of that as far as that goes. So anyway, that's coming. All right.
How long before we know if the Fed has overraised interest rates?
Yeah, so that's what they call the lag, and Chairman Powell talked about this quite often, actually, in his question and answer sessions, including this last one, about trying to understand, the fact that they're raising rates today, it affects the economy at some point in the future. That's a really tough thing. I mean, that's what makes the Federal Reserve job so hard. And so that lag is somewhere between 6 and 18 months, right? So they had a former chairman of the Federal Reserve, not chairman, former governor of the Federal Reserve on the TV. He's saying 12 to 18 months. But Chairman Powell actually made a point about 3 months ago where he said that things are moving faster, because what happens is it used to be that the markets, the bond markets, the loan markets, the mortgage markets, also kind of waited until the rates actually started to go up. And now they're going up just when they start talking about having them go up. And if you think about the mortgage rates, right? It was at 2.73%, 3.5%. And then all of a sudden, in November of 2021, they started talking about raising rates. And before we knew it, we were at 6, 7%, and we barely raised rates. I mean, just a few rate increases, and the market had moved. And so what he was saying is that the impact and the lag might be less, because we saw 10-year treasuries, 2-year treasuries all skyrocket in yields very quickly. Those are all things that slow the market down. And so he's saying in the past, the lag used to be bigger, and they feel that now the lag is shorter, more like the 3-month lag. So we'll see how that plays out. I hope the lag's shorter, just because the danger is that they keep raising rates like they've done even just last week. And the ultimate impact of that comes a year from now, let's say, the beginning of 2024, and wow, and now we're really seeing this. It was too much, right? And that's where the danger lies. And then all of a sudden they're lowering rates again. And that's why the futures market is saying that rates are going to be lowered in the second half of this year, really kind of the end of the year. But nonetheless, and that's because the expectation is that they'll overraise rates. Yep. Which they almost always do, unfortunately. And part of that reason that they almost always do that is because of the lag. It is difficult. It's a difficult job as far as that goes. And, I think that they probably need to slow down here. I know that there's some now probability of a rate increase in May. I don't know that I agree with that rate increase. If you look at all the different things that are happening on the inflationary basis, and you look at how things are going, and although the job market is tight, the wages are actually still dropping, and that job growth is what we need to bring down inflation in services. I think inflation is going to take care of itself to a certain degree already if you keep pushing interest rates on there. So I'll be much more concerned if they keep going a quarter like every meeting. That would be an interesting thing, because the expectation was 2 quarter-point increases in the first 2 meetings, and we got one of them. So.
We have 46 days till the next one. So
yeah, exactly. And there'll be the CPI report for inflation comes out on Valentine's Day, of all things. So coming up shortly, too. And there'll be some more labor reports that are coming out also. So I think the scenario is playing out fairly well here. We got this situation where you can't really have a demand-driven inflation cycle and a recession at the same time. Those are incompatible. So the demand is driving things to be too hot, and a recession means things are too cold. I wonder if these aren't going to offset. And that's where you get that soft landing. And so right now, the data is showing a fairly decent offset, and that's why the market's moving so well, too. Throw in China reopening, and, you've got a situation where, that might help against a global recession. Could be more tight on the inflationary side, but still, all of this might offset each other as we reopen here, and kind of get back down to a normal situation, and maybe earnings can stabilize in that environment. So, all right, that's our show for today. I want to thank everybody so much for coming. Again, send in questions. We'd love to answer your questions. Send them into the email address this next week, and we'll be happy to bring them up on the show. You can obviously subscribe to the channel if you want to increase your education. Hit the subscribe button, the little bell next to it to get notified. And then if you want to meet with Ethan and I, you go to our website. Link is here on the channel. Go up in the corner, you'll see a button looks just like that, and then basically be able to set up a 30-minute time to meet with Ethan and I, phone or video. We'll talk about your specific situation. So thank you very much for coming today. Really look forward to being able to see you again next week, and we'll see you then. Thank you very much.